Hello, I'm Andrew Gagan. In this week's edition of IG Macro Intelligence, we take a look at the FY25 earnings of ASX-listed fast food chain Guzman y Gomez. Fast food chain Guzman y Gomez delivered a healthy FY25 profit, with network sales surpassing $1 billion for the first time. Full-year profit more than doubled to $14.5 million, while earnings rose more than 45% to $65 million. The burrito chain also declared a maiden dividend at 12.6 cents a share.
We had a record 12 months for FY25. The first time we've ever done $1 billion in revenue. The margins of our drive-thrus have never been higher. And the team just executed so well.
Investors pressed the sell button on GYG shares in the wake of its earnings after the first 7 weeks of sales of FY26 came in weaker than expected. FY25 numbers also missed RBC Capital Markets estimates by 7.5% and overall analyst consensus by 3.5%. Shares plunged by as much as 24% in the aftermath of its results, at one point touching their $22 IPO price. They closed lower by a record 18% to $23.70. Wiping almost $545 million from its market value. Stephen Marks, co-chief executive of GYG, told Ausbiz he's not worried about one-day share price moves.
Value of GYG will be represented in time, and we can't control it. Like I said, we had a record year last year. I could not be more proud of this team. And as long as we stick to our strategy and execute, then everything will take care of itself.
Still, analysts have been turning down the heat on GYG's outlook in the wake of the results. UBS has cut its price target on the stock by 15% to $26.50. Morgan Stanley slashed its price target by 26% to $31.20. And Morgan has lowered its by 19% to $30.60. Wilson's cutting the price target by almost 9% to $35.74 a share. UBS retained its neutral rating on the stock, citing concerns around Australian same-store sales growth and a sharp sell-off from investors in the wake of the result. Meanwhile, Morgan's maintains a buy, and despite lowering its price target substantially, it still implies shares can rally a further 21%. Shares are down almost 30% over the past 12 months versus a 16% gain in the S&P ASX 200 Consumer Discretionary Index. Fast food rivals Domino's shares are down more than 36% in the same period, while KFC operator Collins Foods has risen 24%. ASX TradeWatch data show little demand from investors for GYG shares, with the 200-day moving average in a downward sloping trajectory. Still, the average broker recommendation for Guzman y Gomez is a buy, with a target price of $29.43, suggesting a more than 17% upside. Despite being hammered by the market due to its outlook, GYG remains confident of future growth and is continuing with its US expansion plans. It currently has 256 restaurants around the world, including 98 in Australia, 21 in Singapore, and 5 in Japan. It has hopes for 1,000 Australian stores eventually, to rival that of McDonald's. In the competitive US market, GYG intends to open up to 15 restaurants in the Chicago area, with 1 drive-through and 1 urban strip restaurant slated for opening in FY26. Adam Dawes from Shaw & Partners thinks Guzman y Gomez is setting itself up to fail amid an oversaturated QSR market in the US.
In America, the Mexicans have been done to death. So, look, it's a bigger market and they really want to get there, obviously. But with that downgrade, as you say, costs are going to go higher as we expand into the US or expand those stores. And also we've got Chipotle coming into Australia as well. So just more competition, really. So look, overall, I think the stock was way too expensive. We knew that from day dot on the IPO. And I just don't think you need to be there. So if you're asking me my opinion, I'd say sell.
Marx says each American restaurant will need to make at least $3 million a year to be sustainable. In FY25, Guzman y Gomez lost $13.2 million on its 7 US operations, more than double the previous year's $6.5 million loss.
For us, it's all about building brand. We've done it in Australia, so we know what it looks like. and everything's about revenue. So just like in Australia, we're investing heavily in labor to drive revenue and comp sales, just to make sure the food is hot and fresh and making sure we deliver that GYG experience. When I think about the landscape, particularly in the US market, our food is superior than everybody else's. And nobody delivers an experience, right? And we believe that, the mission at GYG is to reinvent fast food and change the way the masses eat, but we're still in hospitality. So it's great to see, obviously, comp sales increase in the fourth quarter of last year. The first 7 weeks have been 6.6%. We've got the right team in place. Building a team takes time. I've never been more confident in the team we have in the US. And now it's just making sure we get more people through the door and we deliver that GYG experience. But as everybody knows, when you build brand, it takes time. But obviously, we're very optimistic in the US. Part of that 15 store strategy is to make sure that we get our AUVs up to 3 million US, which will give us similar economics we have here in Australia. But as always, you build brand, it takes time, but we're definitely on the right path.
And that is your IG macro intelligence for this week. We'll see you again next week.